much cash in the balance sheet in the US since 1952. So they have to do something with this cash. So they may pay dividend, they may buy buy the shares, and they may do external growth. That's why we think that the fund, all ingredients are gathered for the good M&A cycle. So if you see, for example, the M&A cycle, we covered this strategy since 1994, and we saw that there is a cycle of 7 years. Most of the time there is 2 years of weakness followed by a growth of 4 to 5%. And so for us, for example, market was very hard in 2001 and 2002 due to the credit crisis. 2008 and 2009 was hard as well because of the subprime crisis. But each time it was followed by a cycle of growth of most of the time during it lasts 4 to 5 years. And we think that are in the beginning of a new cycle of merger of deals. It's really, as I said, it's really depends on the cycle. Before 2008, we were in a financial cycle led by LBO's deals. So there were so many deals in the market that a lot of players came into the market, long short fund, credit funds, things like that. And but it was a very challenging time in 2008, and that's why this kind of player decreased strongly during 2008. Now we still have LBO deals, but for medium or small size deals, and we are more in an industrial cycle deal. That means we have more players coming from the industry with a risk reward better, in fact, that we saw in the past, because LBOs tend to pay targets at a higher price that an industrial will pay. So that means in terms of risk for us, it's like a flight to quality. There is less player and less risk for such a deal. I think it's a good strategy to play for an allocation in portfolio, because due to the environment, it's not so easy to do a good allocation, and merger could be a good vehicles to do it. If you see this a different cycle, for us the worst wasn't 2008 and 2009. It was 2001 and 2002. Why? Just because there were no deal in the market due to the credit crisis. Because if there are no deals, we can't do merger and acquisition arbitrage, and it's more difficult to do it, because even if the rate of fail in 2008 was high, there were deals. It was more challenging, but there were deals. So that's why for us we feel more comfortable with this kind of period than 2001 and 2002.